Please stand by. Thanks. Good morning, good afternoon, good evening from Buenos Aires. Today is December 2, 2020. We've been away for 2 or 3 weeks, not to overlap with the annual IBA conference and the annual IFA Congress. My name is Leandro Passarella. I'm a tax lawyer and professor of income taxation at UTDT's Masters of Tax Law program. I'm with Professor Celina Valls. Hello, Celina.
Hello, Leandro. Hello, everyone. We are happy to be back to our last dialogue of the UTDT Global Tax Talks. Leandro, could you please remind us which is the purpose of these dialogues, please?
Yes. Following UTDT's mottos of academic excellence, pluralism, and equal opportunity, UTDT Global Tax Talks is a platform fostering an interdisciplinary dialogue among tax law professors, economists, and political scientists, faculty members from all continents, as well as global tax policy makers, on a single hard tax topic. Based on a common questionnaire, they have been sharing their views on the same issues, offering the audience a comprehensive analysis. In its first edition, UTDT Global Tax Talks is covering the impact of COVID-19 pandemic on the international tax system. We have a roster of 13 recognized speakers. We have already talked to scholars from all around the world at different times of the day, on different days, all thanks to technology that has brought us together while being apart. Also with global tax policy makers. Today, we have a last dialogue, the third one with the global tax policy makers, this time from the UN, in what I consider the encore of our virtual tour before our season's finale next week. Today, we have the privilege and the pleasure of speaking with Professor Michael Lennard.
Michael Lennard is Chief of the International Tax Cooperation Section in the Financing for Sustainable Development Office of the United Nations. He's also Secretary of the United Nations Tax Committee. His work focuses on ensuring the fairness and workability of international tax norms, including achieving greater input from developing countries, as well as encourage cooperation to improve tax system as a spur to sustain development that benefit all stakeholders in tax systems. He currently leads the UN Secretariat work on transfer pricing and on taxation of the digitalized economy. He has also been responsible at Secretariat level for the 2017 updates of the UN Model Tax Convention and United Nations Handbook on selected issues in the taxation of the extractive industry for developing countries. Professor Michael Lennard, welcome to the UTDT Global Tax Talks.
Thank you very much. Thank you to you both, and thank you to UTDT. This is a great set of tax talks. I've already found it a very useful resource. I'm glad I'm the last speaker, so I can have the advantage of all the speakers before me, but I just wanted to congratulate you for such a great initiative. Thank you.
Thank you, Professor Lennard. We are honored to have you with us and look forward to our dialogue. But before that, if I may, please let me give an introduction of the topic that we are discussing and remind the audience of the context. Almost a year ago, in December 2019, a minuscule life form, a coronavirus, appeared on our human world. Since then, it has silently spread using human beings and their advances in technologies as means of transportation. Nowadays, coronavirus is an uninvited guest in our lives, and it seems to like it because it is everywhere. And human beings cannot see it or detect it before its unsettling presence becomes real. once it has already infected human beings, jeopardizing their lives. Governments have reacted to the virus spread, requesting us or directly requiring us to retreat to our homes, disrupting our normal lives. Borders have been closed, planes have been grounded. We cannot move far from our places of residence, and if we do, in many cases, we are required to comply with a preventive quarantine. We live very much as if we were characters of a science fiction book. Until an effective vaccine is designed to allow us to get back to normal, which hopefully may happen rather soon, or the pandemic fades away naturally, which at this point seems unlikely, human beings will continue to be pushed to transform our lifestyles. This transformation includes the way in which we do business. Social distancing is now the rule, and electronic commerce is widespread. Everything is delivered to our doors or screens, and this behavior is remaining, although we have learned to coexist with the pandemic. If we change the way we do business, this for sure has tax implications. So far, governments have used tactics and tools already known to them to deal with this pandemic's effects on their country's economies, and their long-term results are uncertain. In UTDT Global Tax Talks, we are discussing various tax issues derived from the challenges that COVID-19 poses to human beings' economic relations, and how states could deal with them effectively to continue generating revenues to provide the essential services that human beings expect to receive from them. For that purpose, Celina and I have prepared a set of questions that was sent to the speakers in anticipation to our dialogues. We don't know their answers yet, but we are collecting their views to have a sum-up session on December 9, next week. Before going to the questions, Professor Lennard, would you like to make some introductory remarks?
Thank you very much. Yes, I'll just make a few brief remarks about the UN tax work. Basically, the UN has a tax committee, which is a group of 25 people that's nominated by countries, and they serve not as representatives of those countries, but in their own capacity. In fact, we have a very distinguished representative from Argentina on the committee at the moment, Carlos Poto, who's also very active in the OECD inclusive framework work. And one of the, I think, the interesting aspects about the UN Tax Committee is that the majority currently, and for most of the period of time, I think for the whole period of time, come from developing countries. And that's quite important. So if it comes to a vote, the developing countries have a majority view. But of course, we try to reach a consensus. It's a very small secretariat, so we have to be very focused about what we can do. And one of the key products, which is very relevant to the talk today, is the Model Tax Convention. And in many ways, it's similar to what's in the OECD, often because there's a common interest between countries, such as fighting tax avoidance. But sometimes there's some quite significant differences, which will emerge from the discussion today, usually because it favours preserving source state taxing rights more than the OECD model does in certain areas. And in 2017, there was a fees for technical services provision, which allows taxation of fees for technical services without actually requiring that there be a permanent establishment. Still has to be negotiated and still has to have domestic law behind it, of course. In 2021, the committee made the decision recently that there would be an article, 12B, on automated digital services. There's also going to be a special article on offshore indirect transfers. And one of the things about the committee is that as part of its mandate, it has to give special consideration to the situation of developing countries. So we try to have the blend of the experience of both developing and developed countries, and also the recognition that treaties have to be negotiated. That's why it's good to have a mix of both developed and developing country experts in our work. Also does a lot of other guidance work, particularly in the area of transfer pricing and also in the area of extractives, but it's developing to give guidance in other areas like the environment. So that's just a brief survey to contextualize some of my comments it's very much a developing focused body, but it recognises that investment is important, that having partnerships with multinationals can be important to development, and that basically we're all in this together when we come to sustainable development. Thank you.
Thank you very much. Carlos Proto is a professor at UTDT. So it's good to know that he participates not only at the OECD level, but also at the UN.
Yes, he's a very valued participant in both fora.
Well, so having reached this point, let's start with our first question. Well, the lockdown has not disrupted M&E's activities. Rather, they have adapted rapidly and have continued to operate remotely. During this period, their management may have been located in more than one jurisdiction. At the same time, some of their activities in other countries may have been performed without the need of any local presence or any significant one there. Home office has become the rule, and many employees and independent contractors have got used to it and may be reluctant to go back to their offices. It may no longer be necessary to travel so often again. Also, some M&Es may have decided to reduce their local presence in some jurisdictions. Assuming that the international tax system continues to be based on the source versus residence distinction, should the concept of PE be revisited and redefined? How? Should these changes apply exceptionally to certain industries, or should they become the general rule? What are your views?
Thank you, Leandro. I'll spend a little bit more time on this because I won't answer every aspect of every question because so many of them have been so well answered, but there's a few where I think I can give maybe an extra dimension that might be useful for the viewers. And first of all, I think we have to recognise that most countries apply both source and residence as a basis for taxation, and both are legitimate in international economic law. So the real question is, to avoid double taxation, which taxing right is going to yield to which taxing right between the treaty partners in a particular situation. And I think the traditional way in which these taxing rights have been allocated under treaties does need constant re-evaluation to see if it still makes sense in the modern world. And that's why at the OECD inclusive framework level and at the UN level and in other fora, there's a lot of evaluation about whether these traditional concepts still work in the same way. And the first thing I wanted to make a point of is that we shouldn't get too sentimental about the permanent establishment concept. You know, I hear people talk about it a lot now as though the permanent establishment concept is one which is applied consistently around the world, where we have the same understanding of it. And that's not really the case, because we have some of the differences between countries which you find expressed in the digital debate at the moment. And also because there are different understandings, because countries sometimes come from different viewpoints. So there's no one definition and there's no one understanding of what is or is not a PE. It differs between treaties. And probably the thing we can most confidently assert is that the whole terminology of permanent establishment is already outmoded, because there was never really any idea of actual permanence. You don't have to be a permanent or anything like that to be a permanent establishment. So it's a concept that almost begins with a lie to start with, that permanence is part of it. But going beyond that, it's you know, if you accept that you don't have to be permanent to be a permanent establishment, which everyone does, the question is, you know, what do you mean by an establishment? Do you really need to have a physical establishment anymore to fulfill the functions of the existing permanent establishment concept? Or do you even need that concept? So even amongst OECD countries, there are differences, as you can see in the observations and reservations, about the way OECD countries approach the idea of what should the permanent establishment concept be in treaties and how it should be interpreted. If you look at the treatment of services permanent establishments, you find a strongly felt view for and against in the OECD model. I think when it was written, at least all the OECD countries accepted you still need some sort of presence in the country. But then in the UN model, I think we've actually been ahead of a lot of other models in saying that, well, maybe you don't. I'll come to that in a minute. You then have differences about how you attribute income to PEs. Some countries follow the authorised OECD approach, and those there are many who don't, and the UN model specifically doesn't follow the OECD authorised approach. And also there's special rules in both the OECD and the UN models that only really make sense because a lot of money can be earned quickly through a presence, but not for any set period of time. If you look at the artiste and sportspersons article, it doesn't make, there's no consistency with approach between that approach to what's a PE and other approaches. It simply recognises that a lot of money can be earned in a short period of time by you know, a visiting artiste or sports person in particular, and that should become accountable in the state where that income is actually earned. And again, it's not too much of a stretch to say, well, if you can earn that money without presence in the physical presence in the country, is that really too much different? And there are even cases which people seem to forget where some OECD and non-OECD countries can tax under existing treaties without a place of business or any degree of permanence in the source country. One example is allowing under the PE article treatment essentially as a PE just because there's an insurance of risks in the country. And that's a provision in the UN model, but it's also something that some OECD countries have put in their model. So again, the permanent establishment concept there doesn't really require anything other than the risk be in the country, which is a very tenuous link. Or also collection in that country of premiums. There's also, you know, if you go back to the history of it, it's a little bit, the people more learned than me about the history of the PE, but it seems to be that the concept was that you can go to a country and you can dip your toe in the water without being taxed on the profits which you make. And then at a later stage, when you engage more closely, you will be taxed fully by the state in which you are. And again, it's questionable whether in the modern world that you should have that sort of two-step approach, or whether you should say if you're earning income in a country, then you should be taxed on the actual profits from the first dollar that's actually a profit. So we do now need to accept that economic engagement in the market is something that has to be accepted as sufficient to meet the test of justifying taxation, and that is happening to some extent under the inclusive framework approach, but it's not really new. Some of your speakers have mentioned the oranges analogy in the 1923 League of Nations report. And then in 2003, the OECD Technical Advisory Group report on e-commerce, which was a very OECD oriented and constituted group. Some of them recognised that even without physical presence, there was a justification for source taxation. And they talked about the possibility that you had derived important locational advantages, an important topic in recent years in transfer pricing, because of the country's infrastructure, which you'd made uses of and which had made your operations profitable. And that can include, this is what they said, means of transportation such as roads, public safety, a legal system that ensures the protection of property rights, and a financial infrastructure. So that's a sort of a benefits approach, which says, well, if you're getting a benefit, why do you need the physical presence? particularly since the physical presence and time tests are so skewed in different areas of the treaty of treaties. But then others will now say, well, you don't even need that benefits approach. The fact that there's use of a market is akin to use of resources which are in my country, and therefore should be taxable without an analysis that says you get the benefit of the legal protection and so forth. Now, so obviously I think there has to be a change. Even a very conservative US Supreme Court recognised in Wayfair that tests of physical presence really don't have much of a reflection on what sort of business is done and how much business is done. And in principle, to the question of should there be different rules for different businesses, in principle, you should have the same principle across the board. But it is possible that different sectors may have different characteristics and that they might be self-ring fencing in effect, or that there might be a revenue leakage that deserves special attention, or an inequity that deserves special attention. And I think one thing to remember, and harking back to what I've said, is that remember we already do give special treatment to some industries. We give special treatment to the construction industry, for example, and to the transport industry under most treaties. So therefore, the idea of giving industries a special treatment, even if it's those treatments are more beneficial than normal, in other cases it may be less beneficial, but they may reflect the realities at a particular point in time of a particular industry. So that's just some general comments on why I think there needs to be a change. And as I said, we shouldn't be too sentimental. We're not moving from a perfect situation to an imperfect situation. We'd be moving from an imperfect situation to a situation with other imperfections.
Before going to the second question, and based on your answer, the question that I have is whether the system is moving or is requesting, or the economy is requesting to move from the residence to a more territorial tax system. And based on what you're saying, I mean, should it be more yield some benefits or some jurisdiction to the territoriality based on what you're saying, and how the VAT may have to be reviewed to not to allow expensing immediately, but to permit the deduction of credits based on an amortization, to have an income tax type VAT, perhaps, and I'm thinking this all out loud based on what you're saying. I'm sorry to bring all these concepts to the table.
Yes, I think that a more destination approach is certainly something that needs to be considered. And the question, I thought it was very interesting in the talk by Professor Shome. I enjoyed his reference to the deductibility of certain elephants, but I thought it was even more interesting that he analysed the split up of taxing rights between capital exporter and capital importer in terms of basically a colonial legacy. And I think there's some truth in that. Many of you speakers have talked about the fact that the Mexico model and the London model were quite different in the League of Nations experience. And probably it's basically because the Mexico model was developed during the war and a lot of traditional powers couldn't travel at that period. So the developing countries had a more developing country approach. And I think where you do have a more developing country approach, you do have a more an approach which looks at the various aspects of what we call source, but as some of your speakers have referred to, I think Martin Hearson gave a good analysis that in part that means looking more at the market, which wasn't receiving sufficient consideration. But it also means considering the place where minerals are extracted and so forth as well. So, you know, I think in some senses we're looking more at a destination approach to these issues, but we're also looking at the more traditional source as well as the market, the place where the in terms of extractives, where the extractives are mined and so forth. And one of the challenges, I think, in the inclusive framework work is how do you square those two issues? How do you recognise the market, but also recognise the extractives-rich developing countries, for example, and their legitimate rights? And there's ways in which that's been analogised, and there's ways in which extractives have been treated as special, which I think is justified. But it is, you know, it is one of the complications of that work at the moment. And I might add too, Leandro, that I think even while there's some recognition of a move to particularly towards the market, and some recognition of the importance of dealing in a suitable way for the developing world, but also the developed world with extractives, there's the big issue is, well, what about the quantum of taxation in the market? So even if you get agreement of some market taxation, it doesn't mean you're going to get agreement as to the quantum, and that's one of the extra challenges. And one of the other things which I think is interesting is that even when you have this recognition of moving away from the physical presence approach, you're still getting references to terms like active and sustained presence, and you know, there's some question about whether there's some of these additional add-ons are actually just creeping back in some of the even the physical aspects of the PE concept, or the temporal aspect. And the temporal aspect, as I've said, you know, that should it really matter how long you're in a country if you're earning profits from the market? It doesn't matter for an artiste or sports person. Should it matter in other cases? It's a very interesting question. And the VAT is also, as many of your speakers have pointed out, it's very important that we not forget the importance of the VAT. Some people have said, let's leave these issues of digital taxation to the VAT. I don't agree with that, because I think it's possible to have a tax on income alongside a tax, a VAT on inputs, and there's nothing wrong with that. And also, whatever the economic realities, the people, the citizenry, will often feel that a VAT is imposed on them, that it doesn't meet their current demand, that multinational enterprises making a lot of money should be paying taxes. So even apart from the actual economic incidence, which I know is debatable, that will cause issues in implementation.
Thank you, Professor. Thank you for raising these very fundamental questions. We would like to move to the second question, which is strongly connected with your previous remarks. It says, is the current international tax system designed to attribute tax jurisdiction among states fairly so that they can generate tax revenues to deal with situations like the COVID-19 pandemic effectively? Why? If this goal is not achieved with the current system, how could it be attained? Which line of policy should be followed to achieve this goal? What do you think about? Thank you.
Thank you. Well, you know, a lot of those issues I've sort of raised in my previous ones, but I think it is, it's important, and I'm just looking at the terms of the question again. Sorry, I'll just be a second. Yeah, you know, one of the underlying issues here is the source versus residence taxation. And as I've said, there's already been a different approach between the UN model in many areas and the OECD model, where it's been most source-based. It's recognised, for example, in the Article 12A, fees for technical services, that fees for technical services should be taxable without any reference to a permanent establishment, that the term really doesn't have any meaning. It doesn't really add, which would mean that you're taxed from $1, where you're actually in the market. Now, what are some of the other issues? Well, one of the issues that's come up is should you even are we overemphasizing corporate income tax? And in the view of many, corporate income tax is not so important. There should be focus on other things. That's not now how I view these things. And all my comments are in my personal capacity, I should say. I'm not representing the UN. And one reason which has come up in some of your speakers' discussions is that the corporate income tax is proportionally more important for many developing countries. And also many developing countries only have a small number of MNEs who contribute a large part of the tax base. And it's not just because of that proportional importance. It's also, I think, a tax morale issue as well. It's important when you're in a developing country and you're trying to engage your populace in paying their taxes, that they do see that others which are who are earning profits in the country are paying their fair share of taxes. And that includes corporates, because people see that corporates, when it suits them, they have a legal personality, and when it suits them, they're a separate entity, and when it suits them, they're a group. And there's a demand that you know, if you expect me to pay my taxes, you should be getting these multinationals who are doing so well, including some of them out of the current situation, the fact that that provision of goods is often happening without contact or with less contact. The fact that we're stuck in our homes, that we're video conferencing on Zoom and Teams and WebEx and so forth. And you know, certain other providers of things, entertainment, for example, are doing very, very well. So I think that corporate income tax is here to stay. It's not the only aspect. It has to be made more robust. Some of your speakers have said it has to be made more progressive. I thought Professor Reuven Aviona was very interesting in his discussion about the role of corporate income tax to deal with monopolies, and to that it should be more progressive as more profits are being earned. So VAT is also very important. There's also all these other issues such as excess profit tax. Do you want to talk about excess profit tax now, or did you want to deal with that later? I can mention that now. I think, again, there's been some very interesting discussions on the excess profits tax in the discussions, and a lot of the analogies have been to wartime. And I think you know, now has a lot of similarities to wartime, and there are solidarity taxes in some countries, and it's certainly a time to think about that. It's interesting to speculate whether, now that vaccines seem to be on the horizon, whether that discussion will lessen, or whether we will think about those issues, at least for the next similar issue that arises as arises here. I did like the sort of the analysis of Professor Aviona that the excess profits tax should apply where you're benefiting from a situation which you didn't cause. And there might have to be some exceptions. There might have to be some promotion of those that are seeking for vaccines and so forth to encourage that. Although in a lot of these areas, there's enough incentive to make profits in an area and the profits are super profits that whether additional incentives are needed in certain areas would have to be looked at closely. And again, some have analogized digital services taxes to excess profits tax as a blunt but a justified way of recognizing that is a new world. High profits are being made. The bricks and mortar industries are often concerned that they might pay their taxes, but they don't have the same and they don't have the same ability to avoid their taxes as some digital providers. And so pressure is coming from other businesses as well as for the consumers to say something has to be done here. So I think the way forward, a lot of your speakers have pointed to the fact that digital services taxes seem inevitable in some fashion. There's the tension at the moment as whether they will, whether they are contrary to the multilateral approach, and I'll talk about a little of that shortly. But I think that one of the big reasons why there's an attraction to the digital services taxes is that they apply in relatively quick time. One of the challenges of a purely multilateral approach is you have to get an agreement, you have to make a convention, the convention has to come into force, then it has to be agreed to that a country will join it, and it has to have its domestic law in place, which can take years. So one of the attractions to digital services taxes is that it's a response to that which is sufficiently timely to meet the public demand. And even if it will later yield if there's an agreement. So I think more and more we will see digital services taxes, even if countries say, but we will withdraw them not only when there's an agreement. Often you see it expressed that they should be withdrawn when there's agreement, that we will withdraw it when there is an agreement which is yielding money because it's implemented in our domestic law. And the other attraction to digital services taxes is that for many countries, they see them as a way which is outside of the existing treaty network, the outmoded principles of PEs in many treaties, and a way in which there can be an accounting for the profits which are being made, but without it being prevented by PE provisions in a treaty which would never have contemplated the sort of digital business which is being done at the moment. That was a point that Martin Hearson made, which I thought was a good one. Thank you.
I think that the third question is just to make some additional remarks, if any, regarding what we have been discussing so far, because what we would like to know is whether this pandemic is an opportunity to shift the current international tax system to set aside the source and the residence concepts. And in that case, which should the substitutes be and why? And you have already spoken a little bit about digital services tax, but what is the role of this tax, of this new tax in this shift? What do you think about these questions?
Thank you, Leandro. Yeah, I'll just add a few extra aspects because I've dealt with some of these aspects. And I think the first is, from my perspective, the first step is actually rebalancing source and residence rather than moving away from it. But I guess it depends on what you mean by source and residence, and as I say, whether you include the market as source and so forth. But from my perspective, that's the first step. And of course, it's something where the UN work has been trying to rebalance a bit of that, I would say, favoritism for capital exporting countries, which has an origin in a time which is far away, and which Professor Chaumet mentioned, including a sort of a colonial approach, that the real value is where the capital is, and the real value is where the risk is taken, wherever that is, and the real value is where the decisions are being taken. And there is a refocusing on particularly the market, recognizing that business is nothing without the market, which was recognized in the 1923 League of Nations report, and that should be acknowledged in some fashion. And it was very interesting when there was a discussion on the value creation. I did an article on value creation in 2018, and everyone agreed on value creation. I think, as Michael Keane and others have said, it was a useful concept when you were trying to dismiss places where no real value was added. But then when you tried to determine where things were happening, whether it's the market, whether it's the decisions, whether it's the risk, where the real value was, it became something which didn't really work. And part of the reason is because different countries had different conception, different people had different conception. If you spoke to most corporates and most developing countries, it was where companies did stuff. But if you spoke to others, and there was a report from India about options on digital services taxes, and they actually treated the market as a place where value is created. Maybe more accurately, it's where value is captured, but it's still such an important part of the modern business life that it's incredible that it was not more important. And of course, some developing countries will benefit from more of the focus on the market. Others will not, because they have very small markets, and there's no single form of developing countries, and therefore what works for developing countries generally will probably be something which recognises the different situation. It will be a very complex sort of evaluation of where fairness lies. And I just wanted to make one point, which is that often we see this as the way in which we move forward, which will affect the technical aspects of what we do when we move forward. It's often seen as a battle between multilateralism on the one hand and unilateralism on the other, and one is seen as harmonious and one is seen as chaotic. And I think it's a little bit more complex than that, because from my perspective is multilateralism has many manifestations. Sometimes it can be a single treaty, a single convention between a lot of countries. Sometimes that's not possible. And sometimes you have to come to the realization, I'm not saying whether this is the case in tax, but sometimes you have to realize you don't have enough consensus to agree on every point. So you can have variable geometries, as I call them, as often happens in the WTO, where different options are given to developing countries as to when they join up and how they join up and so forth. But also in the UN, we see our work on the Model Tax Treaty as being multilateral, because we see multilateralism as having a place in influencing treaties to try and get common language and common approaches, and where you can't reach common approaches, to at least be transparent about the differences and the pros and cons. And we even see that multilateralism has a similar approach in terms of ensuring that if you have a unilateral approach, such as a digital services tax, you try to make it as uniform as possible, because you learn from other countries and learn what's acceptable, what's not acceptable, and how it will apply and how administrable it is. So we see multilateralism as a multi-layered concept, and we think that it influences bilaterals, it influences domestic law, and in turn they influence multilateralism. A lot of provisions, a lot of US provisions have influenced the inclusive frameworks Pillar 2 work, for example. So maybe at this moment it's not a peak time for the classic multilateralism of big treaties and conventions, as one of your speakers recognised. Maybe at this time it's especially useful to say, well, what are the other options to be more multilateral in encouraging treaties and domestic legislation, which is as uniform and as commonly languaged and commonly understood as possible. One final thing which I've mentioned before is that and it deserves mentioning again, is pure multilateralism of the treaty can be very slow, and especially in COVID times, budgets can't wait. Then there is a lot of I have a lot of understanding for countries to saying, well, we can't wait. We can't wait. We have to do something. But I'm in the UN. I believe very much in multilateralism. We think that a multilateral approach is better in the long run, and this is temporary in that sense. But we can't assume that everyone's going to reach an agreement. And the other thing, you can't assume that every country that you want to be in a multilateral agreement is actually going to join up. So that's a sort of a broad expression of where I see things heading. And the bilateral final point is that a lot of people say, well, the UN model, Article 12A, whatever you think of it, it's going to be slow anyway because it has to be negotiated. So it's not any quicker than a multilateral. But I think some of these other measures and even the work within the inclusive framework can have a signalling function. It can say that we in the developing world think that taxation on gross is not inherently bad. It's not inherently contrary to any principles of international economic law. Obviously, it should be moderate. Obviously, you want to encourage investment, and obviously you should bear that in mind. But it's not inherently contrary to any principles of taxation. That's withholding taxes, taxing on net, and importantly, taxing based on present in the market is completely consistent with international economic law. It's just that the bilateral treaties we have from the past sort of said you couldn't do that in the treaty relationship, and maybe that's what has to change. Thank you.
Thank you. If I'm not mistaken, the foreign tax credit was created as a result of a unilateral measure by the US. So perhaps something may happen with the digital services tax to make it as an income tax, to look like as an income tax. I mean, there might be a race as there is currently in getting the vaccine to get a very efficient digital services tax that looks like an income tax, and that may be adopted multilaterally afterwards, perhaps, or we have to strive to that.
Well, I think one important factor will be what's happening in the regions, what's happening in the European Union, what's happening in Africa. The African Tax Administration Forum has provided some guidance on DSTs. And of course, any guidance on DSTs has to recognize, for example, that there might be a trade war that might result as a matter of that. But again, I don't see the argument, well, this will create a trade war, therefore you shouldn't do it. That's in itself doesn't really take you to the argument, because if you say unilateral taxes approaches are bad because they might start a trade war, well, the trade wars which are being discussed, as I understand it, it's under Section 301 of the US legislation, which is a unilateral measure. So, should there be criticism of unilateral measures in trade as well? And that's not to draw a comment on in any particular country's measure, but unilateralism is everywhere. And obviously countries need to bear in mind what will be the response to it. But they might decide, well, there will be a response to it, but in the long run, our people demand it, and we'll try to limit the response, and we'll talk, and we'll try to end up with something which is more acceptable generally. But it is at the moment we have unilateral trade measures via unilateral tax measures, and who's to say which is right and which is wrong? Certainly not for me to say.
Thank you very much, Professor Lennard. So I think that we can move to our next question, which is related to transfer pricing. We would like to know, what do you think about that this, as you know, this pandemic affects the multinational intercompany transaction comparability. So what do you think? Which are the challenges and possible solutions to determine the arm's length range during this economic downturn? What do you think about?
Thank you. This is one of your most challenging questions, actually. And in some reasons, it's not, in some aspects, it's not so much a big issue for a lot of developing countries because they already have deep comparability issues. Because in a lot of countries, they don't have access to comparables, which they trust. They don't have local comparables in particular, often because the data is lacking. There's no requirement to provide the data, which then goes into the transfer pricing databases. Now that's improving, but for a lot of developing countries, they already have massive issues on comparability. And you know, that's not to give up the platform for collaboration on tax, which is the UN with the OECD, the World Bank and the IMF, and it's always good where we do things together and show commonality to the world. They did a very good toolkit, or we did a very good toolkit, as all of us, all the secretariats were involved, on comparability and dealing with issues of comparability and giving some practical advice. Now, the next step is, if you can do that, of course, now you have the issue is how relevant is this, what's in the databases for a period of time, which was an extraordinary period of time. And I know the OECD is planning to give some guidance. How useful that guidance can be, time will tell. We will have a new membership of the Tax Committee next year. One of the issues for them will be, do you want to give some guidance on this? Do you agree with what the OECD has done? Have you got some extra elements you want to add, and so forth? But it's already, comparability is already an issue. And in the UN, we haven't given up on arm's length pricing because of the comparability issues. We think that they can be dealt with in an imperfect way. But also for a lot of developing countries, even getting access to the databases is an issue. So it's not exactly clear how much COVID-19 makes worse, or how much it just shows that comparability is a problem that we need to think about. And you know, obviously there's some trend toward seeking simplification of transfer pricing. The efforts to achieve that have not been perfect. Profit splits, I remember when profit splits became more fashionable, a lot of people thought this is great, this is a simplification, but profit splits are not simple. But we will have to consider in the UN, as in other bodies, you know, how we can give guidance in that respect. Not sure what that guidance will be at the moment. The other issues for transfer pricing are the issue of losses. And there are some big losses there. And how do you account for them? How are you fair to companies which are investing in your country, that you recognise not just profits but also losses? And you know, that's an important issue, and I think it's becoming a bigger issue wherever transfer pricing rules are being discussed. But on the other hand, you also have to bear in mind that developing countries are worried that losses will be abused, that you'll get loss shifting to, so they have a concern that while they want to do I think generally they want to do the right thing by corporates and recognise losses, that there will be abuses, and are the rules sufficiently robust to deal with those abuses, as in, is the information enough to allow them to deal with those abuses? So one of the aspects that's happening now, which I think is, I wouldn't have predicted some years ago, is the increasing acceptance of formulary approaches. And maybe in part, even in business, the complexity of transfer pricing is bamboozling everyone. And maybe there's a greater acceptance in business in the past that formulary approaches may be a way forward. They won't be perfect, but you might be able to get something which is workable both for business and for countries. We also have a push for more less separate entity approach, less of a transaction by transaction approach. And I think over time we will see an approach which tries to reduce the reliance upon comparables, while at the same time making sure that better comparables are available and that non-local comparables can be, can be trusted for use in developing countries. Thank you.
Thank you, Professor Lennard. We are moving now from the corporate side to more the individual side. And what we have seen in this year is that many countries have been discussing or are currently discussing the convenience of levying a wealth tax to collect revenues to afford the economic strains created by the pandemic. Do you think that such a tax would be a solution, or could it create more problems in the future? What do you think about it?
Thank you very much. Again, some of the comments from Michael Keane and David Bradbury, I thought were very interesting when I was listening to them. And for some countries, a wealth tax will be appropriate, and it will depend upon the culture of the country, and it will depend upon perceptions, and maybe it will depend upon the strength of the government, because wealth taxes, as many people point out in the past, they haven't yielded a lot of money, often because they've had to have all sorts of exceptions which have been made to them. And they, the answer is, if they are to be effective, they can't have too many exceptions, but they have to be set at the wealthiest of the people. There's some issue of mobility of those people. And as some of the speakers have mentioned, there might be more of an opportunity with greater sharing of information and with digitalised approaches to tax administrations to actually deal with issues of assets which are held offshore and so forth. One of the other points which I thought was interesting, and I have a lot of sympathy with it, which both Michael and David mentioned, is the fact that you do need to consider whether taxing capital assets might be able to achieve most of the same things. And again, that will have some issues in some countries. But I think certainly I thought they made the good point that a good system of taxing capital assets, capital income, as they called it, some of them, is may be able to achieve some of the same benefits. But as always, it will be a political will issue, and it will be a question of some countries there'll be constitutional issue, as we know. But in some countries, I think it would be possible as a measure of solidarity, and maybe some of the solidarity taxes at the moment and some of the discussion about solidarity taxes with COVID would help pave the way. Because one of the issues that we do have is that one thing that COVID has really shown is the inequalities in society, and the inequalities between the richest and the poorest, and the inequalities between countries. And one of the big tests will be the vaccine rollout. To what extent are those inequalities being addressed between countries? So wealth taxes, I think, have a role on the issue of helping small countries, which I think is there's other issues that's also been mentioned. You can have the recovery taxes, the solidarity contributions. Often it's easier to get support for them than for some longer term wealth taxes and so forth. Luxury taxes, as some have mentioned, that plays some role, but there's other aspects like opportunities to have more health taxes, the comorbidities which have been involved in the death rate of COVID point about the need to address some of these health issues and to get the health infrastructure running better than it is at the moment. And carbon taxes as well have been mentioned as something which is not just about climate change, it's about health, which is important, and it's also about bringing in revenue to deal with some of these other issues that have arisen. So I think I agree with those that saying wealth taxes may work in some countries, but in even where they won't, there's a whole range of taxes which it would be nice to think that COVID would force us to think about. How do we build up our infrastructures? How do we build up our resilience? How do we deal with this sort of thing when it happens again? And how do we deal with some of the inequalities that COVID-19 has emphasised? And how do we make sure that our tax systems play their part in equalising some of those inequalities? Thank you.
Thank you, Professor. A follow-up question: if the government were to introduce such tax increases, what do you think would be the reaction of the taxpayer to these tax increases? What do you think about? Or could their government's approach to deal with the situation have any implications on the taxpayer willingness to accept these tax increases? What do you think?
Yeah, I think it's a very good question, and I think the level of solidarity will vary between countries, and maybe in part because of the impact of COVID-19, how they feel the government's performed in preventing it having an impact in the country or in dealing with it. Whether they feel that it's shown a need for greater health infrastructure, better education infrastructure, because education has suffered as a result of COVID, and the culture of the country. So I think the reality is it will vary. Also, some countries are more used to a solidarity tax. I can remember in Australia effectively paying solidarity taxes on the gun buyback when guns were bought back, and also when one of the airlines collapsed. And, you know, there was an acceptance. So you only want a level of solidarity tax when you have the level of solidarity that will support it. And that will vary from country to country. And I think anything like that, as I've said, you have to think, does it exacerbate the inequalities or does it help reduce them? So any tax that you have has to be sufficiently progressive. And I think this is a point that others have made. It also has to make sure that there's a net gain to those who are the most vulnerable. And women are one of the most vulnerable groups in COVID in many countries. And finally, the test of which is related, the test of solidarity will depend a lot on the expenditure policy. You know, how is the government spending on COVID? Is it spending in a way? How's it rolling out the vaccine, for example, will be an issue. So, you know, it will depend upon what happens in particular states, but wage earners will not want to feel that they are even in a solidarity tax situation, that they're not yet again bearing the brunt when others are not. Thank you.
Thank you. So perhaps, at least this is my comment. If leadership has been solidarious, there might be a more willingness to accept the tax increases. So this is.
I agree, and I think leadership has varied from country to country enormously. If you look at the ratings of leaders and how they've performed, rightly or wrongly, there's great variability. Some have become stars because of their treatment of COVID, and some have not done so well.
Like Prince John, you know, from Robin Hood. But anyway, let's go to the last question, okay, which is whether this pandemic requires policymakers to think out of the box, to find new collaborative solutions to help the vulnerable rather than the usual tax increases and money printing techniques. In other words, do poorer countries have a claim to receive tax revenues from richer countries to help them cope with crises like the COVID-19 pandemic? If that were the case, what kind of obligations could be imposed on them to receive such assistance? What do you think about this?
Well, I think the first point is it came out of the box, and therefore it probably needs out-of-the-box thinking. And not just to respond to COVID, but to think about what it means for development from a UN perspective, and what it means for inequality, and what it means for dealing with the next unexpected out-of-the-box approach. And that sort of out-of-the-box thinking. One of the comments someone mentioned, I think, was saying that, once again, maybe it was about treaties, but maybe we need the 5 economists, or another 5 economists, to look at this issue. And this is an issue where I think a sort of a multidisciplinary group of wise men and women, more regionally scattered than the economists from the League of Nations, there's real parts to play for a body which would give thinking, and which wouldn't be bound by some of the same political aspects that, particularly tax at the moment. I mean, it's good that tax is so political. It shows the importance of the issue, but also it sometimes stifles debate. I find at the moment that the academics and civil society is playing a really important role in the issue of reform of international tax norms. And partly it's because they can talk more readily than people who are civil servants and on such a politically charged issue. So a lot of the out-of-the-box thinking will come not just from governments, but from academics and civil society and others. And business and taxpayers should be involved in that as well. So what I think one of the things that COVID-19 has shown is it's really clarified and it's really intensified our focus on some of the issues that aren't new. The fact that we are shifting to new ways of doing business, where there's less contact, there's less physicality. It's also focusing on the health vulnerabilities that we're aware of. It's, maybe focusing us more, as I mentioned, on the importance of education, on the importance of infrastructure, on the role of governments in providing something, because often when times are good, people think, I don't want to pay my tax because I don't need anything from the government. But I think in COVID times, the role of government is reaffirmed, and therefore the way in which governments tax and spend, I think, is something that we look at. And as I've mentioned and you've mentioned, that the pandemic has really shown the depths of inequality in countries and globally. Some of the poorest people are often the most susceptible, and it's partly because of health issues. It's partly because of the jobs they do, the medical jobs, the shop assistants, in America, and I'm sure other countries, the meat workers have had a lot of COVID issues. So, again, as always, the poor are the ones who are at the front end of the burden, which is part of the inequality. Also the home conditions, crowded together often and so forth. And the people who are losing their jobs are often the people like me. In some ways you're better off because you don't have to pay for travel, and you don't have to pay for quite so much dry cleaning, and the expenses are down. You may not be consuming as much because you're not getting out as often. But so again, the inequality between someone like myself and someone who's lost their job are just continuing, and the inequality between people who have reserves of savings and the people who are not. So how do you deal with that? And then at the country level, you have the similar issues that a lot of developing countries are commodity dependent and prices have dropped. They're tourism dependent and tourism has dropped. They have severe debts as a result of COVID, and they're not in the position to, as you said, to print money as easily as developed countries. So what's the answer? Well, I think the answer is not necessarily a direct transfer of taxation from the developed to the developing world, but something which comes close to that. First of all, a recognition of a fair result for developing countries in resetting the international tax norms, which I've talked about at length. And the second thing is that even though domestic resource mobilisation, as many have commented in this series, is the most effective and most sort of dignified way of achieving the Sustainable Development Goals and responding to something like COVID-19, and importantly building up better so that after it's gone, you're in a better position to deal with something like that in future. But there's still a place for aid, for official development assistance. And there is a goal, which is, I think it's about 50 years old now, and there's a frequent call in the UN for countries to commit 0.7% of their gross national income to aid, to official development assistance. But still only about 6 countries do that. So while some people find the idea of a direct transfer of taxation from one country to another as difficult to bear, this is something which really its time has come long ago for countries to make a commitment about the aid that they're giving. And of course it comes from their tax funds. And it's a recognition not only that it's the right thing to do to show solidarity with other countries and with poor people in this area, but as a matter of international stability and international peace, it's important that that countries be seen as assisting other countries and that richer people be seen as assisting poorer people. There's other proposals like IMF special drawing rights is one proposal. There's a UN COVID fund which deals with particular issues in particular countries. There's not enough money in that, but it's there are these other measures, and of course that's a contribution by countries. So even if a direct transfer of taxation is not the answer, a fair system which gives developing countries what I would see is a fair allocation of taxing rights under treaties so that they can better respond to these issues. They have an obligation, of course, to make sure they have a government which seeks to effectively meet the needs of their people and meet the Sustainable Development Goals. But also these other proposals are in the air about, and we've heard other proposals during the talks about, taxes on financial transactions and so forth, which is a long-term issue. But certainly now is the time. My only, not concern, I'm very glad that the vaccines are appearing to be looking to be quite effective, but that if there's too much delay in these things, that the opportunity will be lost and we'll just go back to the normal until the next disaster hits. And the other big thing is that COVID, I once saw a cartoon which basically was climate change saying to COVID-19, I wish I had your publicity agent, because there's been so much attention on COVID-19 and the need to respond to that we are forgetting the climate change issue, which has massive implications for the developing world, for poor people, and also for intergenerational equity, which is something we shouldn't forget about. I think having given the next generation the problem of climate change, we should pay particular attention to tax systems which support resolving those issues. Thank you.
Thank you very much, Professor Lennard. I think that we are in a position to see the question from our audience. If you agree, and you have some minutes, we can move to the question from our audience. Andrés Baez was a speaker of one of the previous dialogues, and he has some question about the new articles 12A and B. I'm going to read the question, okay? Is the project 12B on automated digital services really necessary? Are automated digital services not technical services? Is the necessity of Article 12B not just the result of a self-restrained interpretation of Article 12A in the commentaries of 2017? And besides, if 12B is finally introduced in the model according to the current proposal, will the asymmetries between 12A and 12B make sense?
Yes, it's no, it's a good question. 12B, as I should point out, is not a product of the Secretariat, it's a product of the committee, which is as it should be. So I don't want to speak for the committee. And of course, it's under evolution. There'll be a subcommittee meeting looking at the text. But there was a very good draft which was done by several, including Carlos Proto, who was a leading proponent on that. Now, I think if you look at it closely, you'll see that there might be some overlap, and there is a provision for overlap. I think the provision is that Article 12B yields to Article 12B in the situation of an overlap. But I don't think every automated digital service would be a fee for technical service. Technical service does have a wide definition, but it does, you know, it's not an unlimited, so it often includes things like consultancy fees and so forth. It's not every type of service, and the commentary on 12A indicates that. So not every provision of an automated digital service in 12B would be a technical service. The automation alone may be one factor in the difference. But I think if you look through the commentaries, you'll see that there is a difference. But it's a good question, and it will remind me to have a look through it, and before the next subcommittee, seeing if it's clear enough where the dividing line is. On the second point, if it's introduced into the model, will the asymmetries between 12A and 12B make sense? And one of them is that, for example, that 12B at the moment has a provision where it becomes a net taxation, for example, whereas 12A doesn't. And there are some other asymmetries between them. And I think, you know, there will be a consideration about whether any changes are needed to 12B as a result of 12A, or more likely, whether any changes needed to 12A because of 12B. I think any changes to 12A, this membership of the committee only has one more meeting in April to make its decision. So I suspect if there are any changes to 12A as a result of 12B, then that would probably be the next membership of the committee. But certainly it's a good question. There are some asymmetries, and the papers on our website, the UN website, if you type UN Tax Committee, you'll find it. There was actually a very comprehensive commentary on some of the comments which had been made, which was put together, particularly by Carlos and also by Rajat Bansal of India, but also by other members of the drafting group, responding to a lot of the criticisms. And one which I'll just mention, because it's come up, it's not directly answering this question, is the argument, well, it'll just be passed on. So, you know, what's the purpose of doing this? And it's possible it will, it's possible it won't. Some providers in the UK have said that they will pass their taxes or their levies onto the consumer. Others say we won't. But remember, we've had the same argument for royalties, for example, that if you impose a royalty, it'll just have to be passed on. And interest in particular, if you impose interest withholding tax, it'll just be passed on to your person who's borrowing the loan. And there's some truth in that, but it still doesn't mean there's a difference between someone in your country having to pay a tax and the fact that that tax might go towards, you know, paying for the infrastructure needed for COVID, for example. So that even if someone in your country is paying the tax, hopefully it's at a moderate rate, then as an acknowledgement it should be, that it might still benefit your country when the benefits from that tax go to someone else who maybe needs it more. Thank you.
Thank you very much, Professor Lennard. I think that we are reaching to the end of our discussion. Before we finish, if I may, I have a personal question regarding the painting that you have at your back. Is that an Australian eucalyptus that you have?
Yes, indeed it is. I'm glad you've noticed that. This is a Flemish painter who came to Australia many years ago. He's long dead, and he painted Australia with a sort of a Flemish Dutch still approach to, not still life, but approach. It's actually in Victoria in Australia. It's where my mother came from, so it's my tribute to her. But it's universal. It's the water, the trees, the cows. But I'm glad you enjoyed it. But it's a Dutch Flemish. I think he was actually Dutch, but certainly from that part of the world. Interpretation of Australia in the early 20th century.
Well, hopefully there are no crocs jumping out of the creek.
No, not in Victoria.
Exactly.
A koala could jump down on you, but it wouldn't do it intentionally.
Thank you very much.
Thank you very much. I enjoyed the talk. Thank you.
It's been a pleasure to speak with you, Professor Lennard. We thank the audience to stay this much time, well, we'll be joining you again next Wednesday at 1 p.m. GMT to finish this first series of UTDT Global Tax Talks. We thank the audience throughout all this series, also the speakers that have participated, and we look forward to seeing you next week when we finish with the conclusions. Thank you very much. See you next week. Thank you, Professor Lennard.
Thank you both. Thank you.
Bye-bye.
Thank you, Professor. Bye-bye.